Most traders don't fail because they carry out the worst trade analysis. They fail because they enter too early or exit too late. This video is a framework to help you get precise trade entries with your setups so you can make the most out of this setup. So before we get started, I just want to let you know that I put together a complete trading framework titled the Chart Pattern Playbook. It's totally free. Use the link in the description below to get that book. It's free. It's going to show you how to identify market structure, how to follow up with chart patterns, how to get good entries, and help you build, good trade opportunities, right? So help you identify high quality trade setup. It's totally free. It's called the Chart Pattern Playbook. Use the link in the description below to get our book on the pinned comment. Let's get started. So when you open your chart, the first thing you do is identify your market structure, which could either be a bullish market structure or a bearish market structure. So you can do this by paying attention to the higher highs or swing highs and swing lows. So if you have higher swing highs and higher swing lows, like the diagram I just drew, then that's a bullish market structure, right? So you want to look for opportunities to go long. That's the purpose, the so popular purpose of identifying the structure of the market. If the market is creating lower swing highs and lower swing lows, then it's a bearish market structure. So the reason why this is important is because then you want to open trades to go short. But the problem most traders face is they know how to identify the market structure. They know how to tell if it's a bearish market structure or a bullish market structure. But the thing is, when they come into area of values like this, they want to go aggressive, right? So if you come into an area of support, you want to go long. So something like this, you come into an area of support. After identifying your trend, you want to go long immediately. You want to go long over here immediately. You want to go long immediately over here, right? So this is an aggressive way to enter trades, right? So if you're going to go aggressively, you need to understand that you are getting yourself exposed to possibility of fake outs, right? So the possibility of fake outs or possibility of being used as a liquidity, right? Like SMC traders call it, they say you turn to liquidity for the big guys, right? So if you want to avoid fake outs or avoid being used as a liquidity, then you want to watch out for confirmations, right? So two things happens. At support levels, you want to go long immediately. We get into those area values, which can sometimes be entering too early, right? So even at resistance levels too, these traders, they tend to go in too early because you come into an area of resistance. Ideally, your intentions is to go short, right? But you go short immediately, But how do you know this isn't going to turn into a fake out or this isn't going to go higher to go grab liquidity somewhere before reversing? That's what we're going to be taking a look at today. So the first way to prevent this would be watching out for liquidity grabs, potential area of liquidity. Now, take a look at this chart below. So this is CHF JPY chart on the 2 hours time frame, right? Over here, if you went aggressive, you would have gotten it right, made some profits, right? But if you tried that over here, you would have gotten wiped out because price went on to grab liquidity, then continued in direction of the market. So some traders, even if they carry a good analysis, they identify the trend as being bullish, how do you know this is not going to be a fake out? The best way to know is watching out for potential area of values, price levels where the market could go grab liquidity before it reverses. And if these levels are found underneath the area of support, that's an indication for you to wait. Now, the example you can see in my chart is that we have an area of liquidity over here. And liquidity are usually in forms of consolidations, right? So if you have a consolidation here, this means there's a good chance price breaks through this area of support to come grab the liquidity over here in this consolidation. The reason is because consolidations are area of values where the bulls and bears get into a tussle, struggling to get dominance with the market. And this is even more amplified if that area of liquidity aligns with an area of resistance. So we have a previous area of resistance over here, which coincides with an area of liquidity. Why would you want to go long immediately over here? Over here, right? So the best way to to go into trades like this is to time your trades properly. And the best way to time your trade properly is to wait for price to come into this area of liquidity, grab liquidity and move back above into the area of value, where then you cannot look for opportunities to go long in line with the trend. That's how you get the best entries. But most traders don't pay attention to this. They only watch this, and because it has happened twice before, they want to go long. Now, I'm not saying price grabs liquidity all the time, right? So this is just an extra layer of confirmation before you jump into those aggressive trades that leads to, you know, you being wiped out all the time. So this one example, right? Let's take a look at another one on the GBP/USD. Now we're still on watching for confirmations before, you know, taking your trade positions, right? Now, if you take a look at this chart, you can see over here we have a bearish market structure. So remember, the ideology is watching out for swing highs and swing lows, and if we're creating lower swing highs and lower swing lows, then we want to go short, which is exactly what we can see on Euro USD. So now, GBP/USD. So just identifying this alone will prevent you from attempting to go long here, because some traders just go on chart, they see a chart pattern and they want to go long immediately, right? Meanwhile, I wrote a book on chart patterns, right? So it's called a chart pattern playbook. If you're interested in getting this book, it's totally free. Use the link in the description below on the pinned comments to get a book. It's going to help you a lot, identifying market structure, watching out for chart patterns, and taking the best trade positions, right? The best trade setup. So just use the link below to get that book. It's totally free, and I'm going to follow up with you via email to make sure you get everything taught in the book. So like I said, when you identify the structure of the market, right, you do not want to go in the opposite direction with structure. Right now, this is bearish. Most traders want to go long here, right? But identifying this alone will already prevent you from taking this trade, because now you know you want to go short, right? Another thing is, most traders want to go short here. Sometimes it works, right? But you can see in this case, it didn't work. And like I said, the best way to wait for this confirmation would be watching out for potential area of liquidity above your area of resistance and area of values. And you can see we have one over here. So for this price chart, you can see if you watch out for an area of liquidity above our major area of resistance, you can see we have one here. And all you have to do is wait for price to grab that liquidity and reverse to the downside and look for a opportunity to go short, right? So another source of confirmation for, you know, trading in line with the trend would be watching out for breakouts. And to get confirmation for breakout, all you do is you watch out for reversal candlesticks, or you watch out for breakout and retest. The reason why this one is not valid as a valid breakout and retest is because the current trend is bearish. So you don't want to trade a breakout and retest in the opposite direction, at least not yet, until you get confirmation that the trend is, you know, the trend has changed or the structure has changed. But in this case, it hasn't. That's why you ignore this one completely, and you see you just save yourself some bucks. Now let's take a look at a silver chart, right? So this is a silver chart on the 2 hours time frame. A proper breakout and retest is waiting for candlestick reversal confirmations, right? So the best way to do that would be checking multiple time frames to see which time frame presents you with a good area of reversal candlestick, right? So in this case, this is a 2 hours time frame, and you can see we've had a good breakout to the downside, taking out this area of value. You can see area of resistance, turn support, good breakouts. You can see a retest. But how do you know this retest isn't going to keep going higher, right? Or reverse to the downside? You do that by watching out for candlestick reversal. And in this case, we have a doji, right? I'm going to zoom in so it's clearly visible, right? So we have a doji. So a doji is one of those important candlestick patterns that most traders overlook. So this confirms your retest. Now, to wrap it all up, we also have a bearish engulfing candle. So bearish engulfing candle paired with the doji formed at an area of value, possible area of liquidity, signifies reversal confirmation, go short in this case. So this is another area of confirmation, another level of confirmation you can add to your setup before you take those trades. Now let's talk about how to pick your exits and stop losses, right? Now, the best places to set your stop loss, if you are going long, for example, the best place to set your stop loss would be the immediate swing low. I'm going to explain. So right now, we've grabbed liquidity. We've been patient enough to grab liquidity. price has broken back above this area of value, which is over here on this candle, then you go long. So this is where you want to go long for a chart like this. Proper break back above your area of value after grabbing liquidity. So you go long. The best place to set your stop loss would be underneath these lows, underneath the previous lows that led to the move back into the area of value, which is this low here. Potential TB will be watching out for swing highs, which is this one over here. So we have a good swing high here, right? Then this gives you a very good risk to reward ratio. The reason why you're picking these highs is because we are in a bullish trend and this is in line with the trend, right? So this is how to exit, because some traders just leave their TP open and expect price to keep going higher, even because we're in a bullish trend. Some traders, they exit too early as well because they put their TP here. So I'm going to explain more on this, right? So they put TP here because this is a high, this is valid, but you'll be missing out on potential opportunities to go long. So how do you take advantage of extended price movement? You do that by trailing your stops, right? So let's say, for example, you open a position here. This is your entry. Stop loss potential stop loss around 70 pips. First take profit targets around 80 to 100 pips, right? When you get here, close half of your position, secure some profit, then adjust your stop loss to break even. This helps you safeguard your trades and prevents you from even losing more to the markets, right? And also gives you an opportunity to keep riding the trend as we go higher while you get to your major target. This is how you set take profits and stop losses, right? So another example for GBUSD, for example, would be this. So if you're going to go aggressive on this after grabbing liquidity, you're ignoring this retest because we are clearly in a bearish trend, right? So you can go aggressively by entering here. If you choose to go aggressive, stop loss should be above these highs because this is the latest swing high or the latest high or even above this one. But this is better to get a more tighter risk to reward ratio, right? So this is the latest swing high before the breakout. So some traders open a trade here and they want to put their stop loss right here. This doesn't work because price could easily kill your stop loss and then reverse to the downside. So that's why you place your stop loss at strategic price levels, in this case above these highs, because when price goes above these highs, then this setup would be invalidated, right? So take profit target, conservative one, first take profit target should be here. Second one, or the major one, should be here. So this first take profit target is the price level where you want to adjust your stop loss to break even. So by the time we get into this area of value, then your stop loss want to be moved to your entry or below your entry to safeguard your trade. So if this is done, then you can freely ride the trade for as long as you want, right? But at least take some profit when we get to these lows. This is how you put your stops and your exits, or adjust stops and exits, right? So for this trade on silver, for example, if you catch your position here after the close of the bearish engulfing candle, your entry can be after the close of the bearish engulfing candle. Stop loss should be placed above these highs because this is the next high, right? This is the latest high before your entry. So you enter here, take profit target, first one can be placed here. So going back to the 1 hour time frame, so you properly see the candles, right? So first take profit target could be placed here. Second one can be placed here. So the reason why this is a very good area to take your take profit is because it also aligns with these price levels, right? So a very solid AOV, right? So area of value, area of liquidity, nice rejection here before. So there's a good chance price comes back into this level. When price comes into this area of value, you adjust your stop loss from these highs now to your entry. So this gives you an opportunity to ride the trade risk-free. So when it comes here, you close some of your positions. Stop loss has been adjusted to entry, so now it's a risk-free trade. So you can hold the rest of your positions if the market decides to go lower. This is how you pick your stops and your exits. So one last thing I would like to talk about is, how do you know a trade is worth it? So this is where we talk about risk to reward ratio. For every trade you take, always aim for at least a 1-to-1 risk to reward ratio. At least for optimum results, it should be at least 1-to-2. In my opinion, that's what I do. So even with a win rate of 50%, you still end up in massive profit if your trades are aimed at a risk reward ratio of 1 to 2. It doesn't have to be 1 to 3. If you get 1 to 3, it's totally fine, right? So give you one example, right? This trade is worth it because after your entry, right? After your entry, yeah, stop loss is approximately 200 pips. First take profit is 500 pips, which is a 600 pips, excuse me, which is a risk to ratio of 1 to 3, which is decent, like absolutely decent. So if you're able to catch 1 to 3, you can even close at 70% of your positions here, adjust your stop loss to entry, and hold the rest of your positions for wider profits, maybe to a risk to ratio of 1 to 6. But at least the first target is here, which gives you 1 to 3. Arrow, right? So this is how to tell that this trade is worth it. So I'm going to show you another trade that isn't worth it, right? Take a look at GBUSD, for example. Now, the reason why even paying attention to whether a trade is worth it or not helps you prevent losses is that if you take a look at this, right? If you enter on a breakout here, ideal price level to put your stop loss would be underneath these lows, because this is the low, the immediate low before the breakout, right? And your first take profit target ideally would be around these highs. Now, if you take a measured price movement, entering here and exiting here will be aiming for a take profit target of 36 pips first, and your stop loss will be around 50 pips. So your take profit target is not even as wide as your stop loss. So this trade isn't worth it. And this alone should tell you that, no, I'm not getting into this trade at all. Even before, so that's if you even forget to check the trend, right? So understanding your risk to reward ratio can help you avoid so many stupid trades. Now let's take a look at CHF JPY, right? Now, if, for example, you enter here after the breakout, right? Stop loss will be placed underneath this low, like I explained earlier. First take profit target can be around this area of resistance. So this is the major area of resistance, right? So if you take a measured price movement, so second take profit target will be around here. Yes, we have that unlocked. So if you take a measured price movement, entering here means your stop loss, excuse me. So entering here will mean your stop loss will be placed around its lows, which gives you a stop loss of approximately 70 pips. First take profit target is around 100 pips, which is decent. So your first take profit target is higher than your initial stop loss. So if you get here, you can close half of your position, adjust your stop loss to break even, and your potential TP extended to these price levels, because now you are running a risk-free trade, which brings your total risk reward ratio to 1 to 3, right? This is how you tell if a trade is worth it or not. So that's it briefly for this video. If you love the content, please leave your thoughts in the comment section down below. Let me know what you think. If you disagree with me, also leave your thoughts in the comment section down below. And remember, I put together a complete trading system titled the Chart Pattern Playbook, right? It's going to teach you how to properly enter positions, how to watch out for market structure, and I'm going to follow up with you via email to make sure you get everything done. It's totally free. Use the link in the description below or the pinned comment to get access to that book. That's it from me, guys. If you love the content, please like and leave your thoughts in the comment section down below. See you in the next one.